Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi Ho, it is the man himself, the professor, Mr. JEng. James, how are you?
Great. Thanks for having me, Paul.
So James and I and the host of lots of the Old Capital group had a bunch of people over to the Grapevine Convention Center this week. And we probably had 350 people or so that had RSVP'd for it. So we had a lot of folks over there. So we had a big group to listen to a little bit about what is going on in the marketplace. A lot of people who listen to the podcast are always looking to kind of get an insight about what we're seeing, how the market's doing. Should we still invest in multifamily? I thought what we would do is kind of do a recap of our conversation last night, that the 350 people that sat down in the chairs. We don't record those type of things. Sometimes it's very difficult to record at a big group like that because it's such a big auditorium that the sound just bounces all over. So we're just going to kind of highlight some of the points that we thought were important. CONKLIN from Pensford came into town, and he's from North Carolina. He is the interest rate guy. He kind of understands a little bit more than the average person. He's not an economist, but he always is talking about interest rates because at Pensford, they're the interest rate people, and they provide interest rate caps to commercial real estate investors to kind of protect if the interest rates are starting to rise. They offer like an insurance policy to protect groups that are buying multifamily or commercial properties or office or retail. So he had some unbelievably great insight about what's going on. I thought we'd talk a little bit about JP's conversation, and then at the end, we'll talk a little bit about some of the points that I thought that I wanted to bring up to this group that were mostly investors, some general partners, but mostly just Joe Bag of Donuts, people that really wanted to kind of figure out a little bit more about what's going on, what we're seeing in the marketplace. And so I kind of gave them a little bit of insight. So I'm going to throw it over to James, and let's kind of talk a little bit about JP again, give folks a little bit more of a background on JP and what Pensford does.
Yeah, Pensford, essentially, when you do a floating rate loan, so whether it's Fannie, Freddie, or bridge loan, they help you find the best sort of strike rate on SOFR, which is sort of the base rate that all these floating rate loans are based off of. JP sent over probably 35 slides to us, and some of the stuff got super technical. So we pulled out maybe 10, 15 slides to really take the audience through last night. And it really starts with inflation, and not only where inflation is today, but where it's going. That's sort of how he started the conversation out. And pretty much everyone thinks that inflation is going to be here for a while, at least another year, 6 months to a year. And then sort of as we look out further, then it's going to come back down to sort of the normal 2%. But in the next year, everyone's thinking inflation is going to be high. And that's a problem that the Fed has to contend with. And every time someone goes and fills up their gas tank or goes and buys food, they're feeling that inflation hit. It's not helping the sentiment. Consumer sentiment, I think, is pretty much at its lowest that it's been for a long time. People are looking at their stock market balances. They're looking at the cost of everything that they purchase, and their dollar's just not going as far. The Fed's job is really to stamp that out. And whether it's supply chains, whether it's just the excess demand, they're having to start raising these rates. And one of the slides you talked about was really around the front end of the curve and where 2-year Treasury was a year ago versus today. A lot of people look at 10-year Treasury, and that's moved up significantly. It maybe went from 170 to 280, 290. So that's about a percentage point. But then the 2-year Treasury was sitting at like 16 basis points, and it's all the way up at like 260 now. That would be the same as if the 10-year Treasury went to like 30%. Most people don't follow the 2-year Treasury, but that is just a very, very, very fast rise in the 2-year Treasury. And that front end of the curve is just getting pushed up and up and up by the Fed. And that is the front end of the curve is controlled by the Fed, whereas the 10-year Treasury is controlled more by investors and people buying that paper. That was really how he started was, look, inflation is sort of running at 7-8%, and we don't really know. It might come down a little bit, but it's going to take some time. And the only thing that the Fed can do really is, I'm going to raise rates. And so they raised 50 basis points. They're going to raise another 50 basis points in the next 2 months. And then I think everything is, let's see what that does. SOFR is going to be sitting at just under 2%. And that's really where he stops. So I'll stop right there. Paul, did you want to jump in here?
No, I mean, that's exactly what he was talking about. I was listening to that, saying that if the 2-year it jumped up to what it's done, the 10-year Treasury would have jumped up to 30% in relation. I was like, unbelievable how much that 2-year has jumped up. And again, when we talk about SOFR, we're really talking about short-term overnight borrowings. And that's what that's made up of. And that's the index that we use that changes every day, that we look at probably once a month to just take the average of that SOFR over the period of, say, 30 or 31 days. That's what we're using as the index. So again, when you talk about building an interest rate, we have the fixed rate portion and we have the adjustable rate portion on these bridge loans. And so the fixed rate portion is the profit margin. The adjustable rate is the index, and the index that we're using is SOFR. Keep on going your story.
Yeah, that's really driving the cost of these caps. That's what has really changed on the underwriting side is I think people understand that, look, it's floating rate. If the Fed raises the rate, my debt service is going to go up. I think what a lot of people don't understand is, well, the lender is going to make you buy a cap, and that cap is on SOFR. And I think I've had to explain this to maybe 2 or 3 people already. But essentially, when you go out and buy a cap, let's say 2%, that means that is the cap that you're buying on SOFR, the actual SOFR. What that means is if your spread is, let's say, 400 basis points or 4%, that means your all-in rate cannot go above 6 for the time that you have that cap. The example they used was, let's say you bought a cap on a $25 million deal. It maybe was 80 grand 6 months ago. And now it's 800,000. And
what?
So the price of those caps, because the forward curve essentially was saying that we weren't going to hit 2% for 8 years. They were essentially it was basically like a risk-free deal for the bank. And now that forward curve has changed and spiked up dramatically, that the banks can't make any money if you buy a cap for 80,000 and they have to start paying you month 1 and start paying you out the difference between the strike rate and where SOFR is actually at. The cost of these caps have just gone up tremendously. And that's the second piece that people now have to underwrite is, all right, I've got to underwrite a higher interest rate, but now I've also got to underwrite a higher cap cost. We weren't trying to just obviously it's very difficult to make deals work in sort of a rising interest rate environment. I think a little bit of the light at the end of the tunnel is that on average, majority of the time in the last 4 times the Fed has hiked, on average, it's about 2 years before they cut. And it might move even a little bit faster this time. So we just started hiking this year. So it's going to be more of a wait and see after they hike these rates. It might just flatten out at 2%. But if they do not see sort of movement on the inflation front, then they're just going to keep on hiking. I think that's where a lot of the market is sort of scared. The Fed has moved so fast, and usually markets like to sort of know the rules that everyone's playing by. And when you change direction so fast, the volatility increases and everyone gets a little bit more nervous.
Yeah, one of the things on that I thought was interesting in their slide presentation. And if you send James or myself an email, we'll get you a copy of the slide deck, and so you can take a look. But one of the things I thought was interesting, and I've heard this before with a lot of economists and a lot of appraisers too, is that when interest rates are rising, they go up only for a certain amount of time and then they come back down. So the average is like 2.2 years, but they've never exceeded 3.2 years. If it is in the 3.2 years, I mean, we're going to have higher interest rates from, say, today of 2022 to 2025.
Right. And then, I mean, a lot of people were like, all right, I understand. I know where SOFR is going, but what about 10-year treasury? I mean, is that thing going to go even further? It's sitting at just under 3% today. Where that thing is going to go, because obviously that's impacted residential mortgage rates. It's impacted Fannie Mae and Freddie Mac. And he showed an interesting chart that basically showed since like 2008, there's been a lot of resistance really at the 325 level. Every time, whether it was 2013, whether it's 2018, every time it gets to sort of about 325, there's a lot of resistance and it sort of comes back down. We'll have to wait and see, but that sort of seems to be
You did say that if it breaks through 325, it could go much more higher than that.
Right. 10-year treasury is sort of interesting. It's like the worse the economy is, the lower that 10-year treasury goes. So it's like you can't have it both ways. It's like you either have a great economy or a worse economy and lower rates.
Yep.
In terms of JP stuff, I mean, I think those were the main bullet points that he got through. Anything else on there?
Just a couple of things. A lot of people didn't understand about the cap termination and what that really has meant for some people. Like an example, what he was saying, which I really didn't think through, but I thought it was a good point, is that when you buy a cap, let's say you're buying a $25 million loan cap on that property and you're using SOFR as an index. If you were to buy a cap, let's say for 3 years with a 1% strike price, it probably cost you $135,000. So
last year.
Yep. So again, you bought it last year. Then what you decided to do is that property that had that cap on there, you were able to sell it maybe at a profit, or you just were to sell the deal, but you still had 2 years remaining. Again, you spent $135,000. What is that cap costing today, and what type of term do you get, James? How does that work? Tell us a little bit about that.
Yeah. I mean, if you went out and basically just priced that and got a 2-year cap at 1% strike on a $25 million loan, I mean, it's $900,000, right? So the cost of these caps have gone up 10x. Even though that cap is shorter, there's still value to it. And pretty much the partnership owns that. Let's say you bought it in an LLC and you sell the property, the loan's paid off. Now that cap is still sitting there and you essentially can sell it back just like a financial instrument. You can sell it back and sell it to somebody else. You can keep it and use it on another deal. But most people are just going to sell it, and that's going to be extra proceeds on the deal.
Isn't that crazy? That's the assignment of the collateral, which is really unbelievable, that because these cap rates have gone up so much that you could use a cap that you purchased last year if you sold that property and just transfer it over as a collateral assignment over to the next property you wanted to do. So that was something a lot of people in the audience didn't understand, but then it was kind of crystal clear to them that they were dealing with something that had a lot more value than just giving that money away. Anything else that he said?
I think the one thing that he sort of had an index, let's say the index is at 100, and that's sort of just right in the middle, neutral. And then he showed a graph of sort of accommodative versus restrictive, and then sort of what might lead us into a recession. And the recession piece is really like if financing or lending or just the market is super tight in terms of lending. You see spikes back in 2008. You see some spikes sort of when COVID hit in terms of it just being very tight on lending. He showed the graph of sort of where we are at now. And right now we're still sort of under 100, sort of accommodative. There's still guys lending in today's market, but just the spike is going straight up. It's not like one of these like soft diagonal 45-degree angles. It's like going straight up. So every time the Fed hits the 50 basis point button and cranks it another 50 basis points every month, his prediction was once you get to a 2% SOFR, you're right up into that restrictive territory. And then once you blow past that and you're up to 2.5%, 3%, you might be into sort of putting us into a recession. Obviously, everybody wants it to be sort of a soft landing in between those 2 points. And so that's where we're just going to have to wait and see where it ends up. But he felt pretty confident that SOFR was going to 2% pretty quickly here.
Pretty quickly, no doubt about that. We certainly enjoyed having JP come out and visit with us. He's a great ball of knowledge to have you get some real insight. Remember, go on to Pensford.com, Pensford, Pensford.com, download his newsletter, and then listen to his podcast too to get some great insight when you're talking with some investors. Let's go to the second page. Again, we have 350 people or so that were in the audience. Second phase of the presentation. Again, he spoke for about 40 minutes or so and answered some questions after that. And then James and I kind of came up and we kind of talked a little bit about what we're seeing in not only in the debt markets, but what we're seeing in the real estate markets too that are affecting apartments. And so I was thinking about why I built this presentation is that I wanted to kind of figure out, where are we? What would be a good kind of a phrase? And I was thinking about that Clint Eastwood movie that came out in 1963 or 64 called The Good, the Bad, and the Ugly. That kind of nails what I think is what's going on today. It's a little bit of everything, is that the good really has been going on for the last, say, 35 years. And that's been, say, the 10-year interest rates, real interest rates have been going down ever since like 1985 or 1986. Remember when I got in the business, fixed rates were about 16% on home loans and prime rate was at 21%. And then we had 10-year interest rates that were at 9-10%. Now, those have kind of gone down. And so we hit an inflection point back probably about 60 days ago. So the bad, if that was the good, the bad is really the rise of the 10-year treasury, kind of going from where it was about 150 to right below that back in December to where it is today, right around 3%. It has doubled over a period of 5 months. That's been a crushing piece to a lot of transactions that the interest rates have just doubled. And the index itself has doubled in 5-6 months. But really the ugly piece of the deal has really been the rise of SOFR. And that's the short-term rates and really plugged into the bridge loans that we do a lot of. And again, we've been doing 75-80% of our business has been bridge loans. This is because those bridge loans are not for the buyer. It's really for the seller to try to get the highest price for the property. And so that rate has gone from 5 basis points, 0.05, all the way up to 0.8. And that's only been in a matter of 4 months. So rates have really risen in that. Our discussion really was around just some general observations of what we're seeing, that how the debt markets have changed in the last 60 days and how it's been impacting the short maturities for non-recourse apartment loans. Now, talk a little bit about what kind of impact are we seeing, James?
Yeah, I mean, it really didn't make any sense the last year and a half or so, in that why would a non-recourse bridge loan that has more execution risk, more CapEx, have a lower interest rate than Fannie and Freddie? Like that just doesn't make any sense. And bridge loans might have started at 325 on your spread, and SOFR was 0. And so you had a 325 rate, and then Fannie and Freddie was at 4.5. And that essentially is just reversing now. SOFR is going up. The spreads on these bridge loans are going up. You might have been 325 last year, then you were 350, 375. Now you're 4 over SOFR now. Not only are your spreads increasing on these bridge loans, but then your SOFR rate, your base rate, is increasing. If SOFR goes to 2%, your spread is 4, you're at a 6% interest rate in 2 to 3 months from now. Whereas Fannie and Freddie have sort of just stuck to their knitting. They're going to try to be a little bit more aggressive, maybe a little bit lower coverage, slightly, like maybe a 120 instead of 125, but their leverage is going to still be 50% on today's pricing. That piece of it, Fannie and Freddie staying essentially the same. The underwriting of these deals now has to take into consideration where 10-year treasury is. 10-year treasury is at 3%, and you're expecting the refi out of these deals at 5%. You essentially need 7.75, 8% debt yield in year 3. In order to get to that number, most of these bridge loans are now, it was 80, was 75. Now it's closer to 70%, maybe even 65% of purchase plus 100% of rehab on these deals. That's really where it's coming.
Right. So we're seeing lower leverage, higher debt service, monthly payments on your mortgage are going up. And just like we were talking about with JP, cap rates costs have increased tremendously too, in some cases up to 10 times of what they were. So like I was saying right at the beginning, is that these bridge loans can be good, can be difficult for some groups because it's in the hands of the seller that's kind of determining what they want to accept as a sales price of the property. So what we have seen since the lower leverage, higher debt service, higher cap rates, we've seen values of B and C properties in our market, let's say in Texas, being Dallas and Fort Worth, Austin and San Antonio, some of these B and C properties down 8 to 12% since January 2022. Because of these higher interest rates, we've seen values come down. And we're also seeing a little bit of the difficulties of a little bit of denial between the sellers and the brokers. And that may be 6 weeks, could be 6 months, could be 5 weeks, could be 5 to 10 months, where people haven't accepted the value decline in some of these properties. And it's not a fundamental issue with the property. It's just the capital markets. It's the capital markets. The properties, the incomes are doing well. Everything's doing well on the properties. What we're seeing is a lot of retrading of properties, whether it was at the LOI, that after you said that I was going to buy it at this price, you try to go out there and try to figure out, well, what kind of debt can I get on it? And if you found out debt that you thought you were going to get is not going to be available, or it's at the PSA point where you signed the PSA at that sales price and you probably pushed over $300,000-$400,000 to make that, put that in at the title company. We're seeing the retrading at that period of time too. So not only after the LOI sign, but after the PSA sign and the loan is in motion. James, talk a little bit about that, because I think that's kind of little words of wisdom from you about what people should be doing these days when they're getting close to a PSA.
Yeah, I mean, it's always easier when you're able to sort of negotiate your purchase price, your earnest money, all those things up front. I think some people probably in the last 30 days sort of got caught in the middle. But the reason we're doing this podcast is to inform you that before you, like, if you haven't looked at deals in a couple months and now you're coming back from the sidelines and you're looking at deals, there's going to be less people there at the Whisper. There's going to be less people at Best and Final. And what a lot of people are doing is once they get sort of to Best and Final, we're sort of reviewing their pro forma, going through everything with them and making sure that they can qualify, whether it's 70%, whether it's 65%, making sure that works with their numbers, whether it's higher interest rate costs, higher cap costs, and making sure sort of eyes wide open, I'm going into this deal and it's going to work for me at this lower leverage. If someone sends me a pro forma and they have in there, 80% of purchase, 100% of rehab, SOFR plus 325, and then their interest rate's 4%, that guy's unrealistic on the deal. Making sure that people are realistic on these deals, because the broker doesn't want to tie this deal up for 30 days or 60 days and then have the deal retraded or go back out to market. We're on a lot of conversations with borrowers and listing brokers, really going through and choosing the best pathway, I would say, in terms of loans, whether it's non-recourse bridge, whether it's Fannie and Freddie, or whether it's just recourse bank loans.
60 days ago, 65 days ago, whenever the Fed started to raise interest rates, that was kind of the shout out in the crowded movie theater of the word fire. A lot of people have kind of run to the exits and decided, well, am I going to keep this property and keep buying going, maybe in a bridge loan for the next 2-3 years, or am I going to try to sell the deal? The good news, I think that you're going to probably see more inventory coming down the pike that you've probably never seen before in terms of the volume of that type of stuff. That's going to be the good news. And the other good news is that there's a lot of the go-to apartment buyers are pencils down. Every broker kind of has that selling apartment buildings, kind of has that group that they know they're the go-to groups that will buy this property, and that buyer may not be there. So if you're coming into the market, that may be an opportunity to find a deal that you, maybe a higher quality property that you've been penciled out or drawn out just because you haven't bought a lot of properties from these guys. Now this may be the opportunity to do it, to come in there and do it.
The broker actually is calling you back.
Yeah, brokers are actually calling you back. I mean, these guys the last 3 or 4 years have been kingmakers, making decisions on who wants to buy these properties and who can buy these properties. Now the power has gone a little bit more to the buying group instead of just the seller themselves. Let's go back into these transactions, James. Say you did one of these bridge loans back, say, last year or 2 years ago, and now it's coming on to year 3 or so. and we have these maturities coming. Is there concern, again, I think you hit upon it a little bit, but there's concern about values coming down on some of these properties that maybe they did 80% leverage back 2.5 years ago. They've got to find a way to either refinance or sell the property. A lot of them want to stay in the deal, want to kind of refinance that, maybe the Fannie Mae. They did it at 80%, but Fannie Mae or Freddie Mac is going to be at 50 or 55% because we just don't have enough NOI. We don't have enough income to support anything greater than a 55% loan with Fannie Mae. Fannie Mae is not going to, they're not going to expand the box. They're going to keep the box right where it's at of what the underwriting piece is. What's your concern on that?
Yeah, I mean, most people, when they underwrite these deals, most people would do a bridge loan, and then they would usually try to underwrite the deal and take 100% of my cash out. So if I put $5 million in equity into the deal at my refinance, I've added so much value that I'm pretty much going to get all my cash out. So I'm going to do a cash out refi. I think what some people are going to run into, let's say you bought a deal in 2021 and you were 75, 80% levered, you have to start really pushing rents. So that's the one on the demand side of the equation. The demand is still very strong for apartments throughout all the Texas markets. That ability to push rents and hitting your pro forma in year 3 is key. But some of the steps to year 3 on the way to year 3 pro forma is usually month 18, month 24, there are debt yield tests. If those tests are not hit, they're going to start sweeping cash flow. That might ring your bell a little bit earlier than year 3. Obviously, year 3, you have a loan maturity, but once the lender starts sweeping cash, it's going to be very difficult to make distributions to your limited partners. It might make sense in maybe month 12 to month 18 to start looking at a Fannie Freddie floater if you think you're going to sell the property in the next couple of years, or potentially go into a fixed rate with either a step down or a shorter yield maintenance penalty. Once your property is able to perform, most of those transactions, my guess is going to be more of just hopefully just a cash neutral refi. And so that'll reset your loan term, and then it'll also drop your spread. So most of the spreads on bridge loans were 350 to 4%. And in Fannie right now, you could maybe get 225 to 250 on your spread on floating rate.
So, I don't want to be a negative Nelly on this deal because the apartment operations, the fundamentals are super strong on apartment ownership. So year over year, we've had rent growth, like just the trailing 12 for last in DFW, right around between 17 to 17.9%. So just huge rent growth. And we're projecting to the year end right now about 6%. With occupancy across the nation, right above 96%. So we're almost fully leased out on these properties. And we do have a housing shortage. We're short between 2 million and 5 million of the housing units that are necessary to be where we need to be. We just don't have enough development. And one of the things that I don't want to have any confusion is that when's the last time you looked when somebody was trying to buy a house? Interest rates have gone up. So right now, if to buy a house, for possible, those folks are jumping out being renters to buying a house has become much more difficult because interest rates right now on home loans are about 5.571. It was just a blink of an eye that they were 3.5%. Now they're up 2% higher on a 30-year fixed rate. And the average single family price in Dallas is about $360,000 as of November of 2021. And that's up from the year before 18.1%. These deals everything's gone up. Interest rates have gone up. Values have gone up. So just kind of our general observations, just to kind of finish this off, is that we see if you use caution today, making sure that you're not using yesterday's numbers to underwrite today's deals. Just be careful on that. Focus on cash flow for investors, not just the year-over-year appreciation on these properties. There's bragging rights. I see it on Facebook all the time that we made 50% over the last 32 months to our clients. We made 150% for our clients. Come invest with our deals. Now, I just don't see this year-over-year value appreciation coming with these type of transactions. So focus on lower leverage, perhaps even a lower cap strike price. Instead of doing a 2% cap, box it out and make it maybe 0.5% or 1%. Yes, you're going to have to pay more money up front, but maybe that's just what you need during the period of time that you're going to own this property. And then make sure you fully perform as an asset manager overseeing the property management. I mean, that is super important of kind of overseeing, making sure these people who are working for you are actually doing their job. Go out to the property, go see it, see what's going on. Go drive your asset, be a good fiduciary to your limited partners. And also too, don't forget about having cash reserves. A lot of people are going to crash and burn because they don't have enough money to pay higher debt service. So have cash reserves, just for a rainy day. And then when you're underwriting these deals, don't underwrite you're going to be able to sell or refi in year 3. Think that you may not be able to sell or refi in year 3. And what's my game plan? So make sure you read your loan documents before you close, after you close, and find out where those hurdles that James was talking about that you have to perform at, and be in front of those hurdles that you have to do. Where's my debt yield have to be on month 18, a month 26, 28? Where do I have to be? And so I think those are important things that probably people should be focusing on. Anything more, James?
Yeah, I think when, let's say 2016, 17, 18, a lot of people were doing sort of fixed rate Fannie Mae, Freddie Mac loans. You don't have to worry about this. You don't have to worry about an interest rate cap. You don't have to worry about your debt service coverage changing. You don't have to worry about any of that. A lot of people had, they maybe have a couple months of expenses, a couple months of debt service, and you had a couple $100,000 sitting at the partnership level. And so that worked because you ended up paying a prepayment penalty of yield maintenance when you sold the deal. And you didn't even really feel it because you still got a big check. You still got a big net proceeds check, and you never had to come up with money during your actual hold period. And so now, if you bought a deal in 2021, 2022, and has floating rate debt, now all of a sudden you've got to deal with that higher interest payment. You've got to deal with the interest rate cap that maybe is 2 years, and you got to buy the third year. You might have to deal with interest rate cap escrows that Fannie and Freddie also have. Those things are coming. So you need cash at the partnership level to maintain liquidity. A lot of people are running sort of the analysis of, okay, if my interest rate goes up to the cap, if my taxes come in higher, my insurance comes in higher, do I have enough free cash flow to distribute? So before distributing that 8% distribution for this quarter, make sure you run the numbers and make sure you have the cash flow there, because it's a lot easier, or it's a lot harder to ask for the money back than before sending it out. We want everyone to survive. And whether it's having a little bit more cash at the partnership level or just being more proactive on the refis to a little bit longer term debt, once you can hit those Fannie Freddie hurdles, is what we would recommend.
Let me just give you maybe a couple points, and then we'll call it a day here. But James mentioned, Fannie and Freddie are still great options. They're still available. They're the backup. They're the primary source of mortgage lending, and not only single family side, but definitely on the multifamily side. But they're not going to change their rules, meaning that they have either a 120 or 125 debt coverage, and they look backwards on how the financials have done on the property. They do not look forward. So they're not a pro forma lender. They're not going to give you credit where your rents are going to be 3 years from today. They're looking for what the rents were 3 years back. So they're just not they don't look forward, they look backwards, making sure that there's cash flow on the property. Non-recourse bank and recourse bank loans are coming back. So, we close a lot of bank transactions, not just bridge loans, but actual banks where, like, your grandmother brings in deposits, but they also lend that money out too. It may be, some of those loans may be recourse upfront. And then maybe after you hit a hurdle that the property is at a 125 or 130 or 140 debt coverage ratio, they may start to reduce the recourse back. They may cut it back where it started off at 100%. Maybe it goes to 50 over a period of maybe, after you hit that threshold after 18 months, gets reduced down to 50, down to maybe 25, and then out to 0 over a period of time, trying to help you remove the recourse back from recourse back to non-recourse. And usually bank loans don't have cap costs, and they usually have fixed rates. So they don't have just a straight adjustable. Some have straight adjustables, but ask the bank, can you lock this interest rate up for a while, maybe for 5 years or 7 years or however long you're going to do it? Get them to commit to whatever the fixed rate is. And we're seeing fixed rates on bank loans anywhere from, say, 4.25% up to 5.25%. But if you don't have to pay the cap costs, that's not too bad. You're not going to get 3 years of interest only, but maybe you'll get 6 months or you get 18 months to get this property going. That's something to think about. Again, words of advice for somebody who's been doing this for a long period of time: lower leverage today, focus on cash flow. And a word that I never thought we'd say here in the last, say, 3 or 4 years of been doing this is that think about that if you don't have the cash flow or you don't have liquidity in your pocket and the property is starting to have problems because the debt service is going up or you're exposed to not paying for a cap on your interest rate, is that capital calls. What usually happens is the general partner tries to pay for something and makes a loan to the partnership. But if that general partner doesn't have the liquidity, they're going to have to reach into your pocket as a limited partner and start grabbing some cash out of there. Let's be realists on these deals that if you need to keep these things going, you may have to give money back and put it into the deal. So right now, my belief is live now, make these properties perform as efficiently as you can, and you'll fight another day. So live hard on these properties by managing these properties to the ninth degree, the best you can, save your money, and then fight another day on a property. Anything more, James, on that?
I would just say, yeah, start having the conversation around with your partners on these deals and sort of underwriting them and sort of stressing them now and making sure that you have the capital there. And if it is it's time to go, let's sell this property because we're just not going to be able to either handle the debt service or handle the CapEx or those things. It is much better to sell at a cash neutral position or slight loss than for the bridge lender to come and show up in year 3, month 36 and say, guys, we're taking this property. The bridge lender doesn't want to do that. And the equity does not want that to happen either. So just be cognizant of sort of where the property's at and make sure you make those decisions proactively.
Yeah, some great words of advice from the professor, JEng. I thought we had a good conversation with all these folks last night. I was kind of worried if I was just being too much of a negative Nelly, but I think we pride ourselves for kind of telling people the truth on how the way that we see it right now. We'd rather have these conversations today than just be 100% rah, rah, rah all the time. And I've done this for such a long period of time that I don't need the stress. So I'd rather just tell you what's going on and what we're seeing out there than let you guys make the intelligent investment decisions. I don't know if anything is going to actually change. People are still going to buy properties. Again, the fundamentals of the properties are strong. Rents are good. This is just a capital markets deal that is starting to pull back. But if you're going to be in this business more than 1 year, more than 2 or 3 years, you're going to have to be able to buy properties with interest rates rising. That's kind of the conversation we're having today, is just be able to buy properties, protect yourself, protect the downside, protect your investors' equity that they put in and the trust they've given you with their money.
I'm going to wrap with this comment on a Facebook post. The comment was from Bruce Lynn. He said, "Best funeral I've attended. Great crowd, amazing turnout."
That's funny.
So shout out to Bruce Lynn. Love the comment.
Bruce Lynn, because Bruce, thank you very much. Yeah, it was a little bit of possibly a funeral conversation, but it was not. But it was a realistic conversation around a topic that we have a lot of money with all of you invested in. So we want to make sure that nobody loses any money. So we're having a good conversation. JEng, how's that YouTube channel going on? I actually love the stuff that you push out on a day, every month basis. Tell me a little bit more. When's the next one coming out?
Yeah, I mean, I try to do it at least once a month, and just some of the stuff that we talked through today, it does get a little tricky, a little heavy. I know while you're working out, it is difficult to calculate debt yield on some of these deals. And so YouTube allows you to just sort of put up some examples, some case studies about once a month, maybe middle of the month. We'll try to do a little webinar on what's going on in the market. It just, and try to, I mean, we read a ton and get a lot of stuff from brokers. We get a lot of stuff from lenders, and we try to show you sort of both sides of the coin. One day we'll get a whole package of why this is the greatest investment of all time. And then the next day we get a package and it's the opposite. So we try to show you both sides of the coin so that you can understand and win on both sides. What's it? Heads I wins, tails you lose, or something like that.
Something like that. So again, JEng, thanks for being a part of the conversation today. Again, if you want to get a copy of the presentation that we put out there, just send an email to James or myself, and we'll push it out there for you guys to kind of see the presentation. Again, it's just a PowerPoint presentation that was out there for our conference yesterday. So again, I'm Paul Peebles. Thanks for joining us. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.